start recording. Although this, the YouTube channel already has a decent executive summary on this one. All right, so there's two charts on this one. The first one on the bottom is price in the dark blue line, plotted against the 30-period Bollinger Band, the upper and the bottom, upper boundary and the bottom boundary. That's a 30-period Bollinger Band plus or minus 1. In other words, that's the river. Green is the north edge of the river. Red is the south edge of the river. And this is showing 6 months. So what I want you to notice is for about the last 120 days, there's been a really strong bull market moving out here, which has made 4 legs up from once it made this swing low, which corresponds to these regression line slopes, their z-scores back in the day. That a bullish move started from here, and it had 1, 2, 3, 4 strong moves up, and in each case, the correction came back and held support at the southern edge of the river. That's exactly what it did this time. Now, we don't know that this is a 5th leg until really it gets above the swing high, but all signs point to that being a reasonable expectation. In other words, you should not be surprised if that's what happens. If it does, a price target of 170 is certainly within reach, just on the basis of how far it moved in previous reaction responses. Now, I want you to notice that in this bullish market that price is oscillating around the upper Bollinger Band, the upper north shore of the river. And its excursions to the downside have been held in, if you will, by the lower Bollinger Band, the southern edge of the river. So that's what that says is that you can afford to stock the re-entry opportunities after a positive move, as long as it finds support at or above the southern boundary of the river. You're still authorized to believe that could be a nice move up or the next leg up. And again, in each case, you get paid by being able to harvest the stops before you get the full pain here. Now, if we took the regression lines of the 10-period, 30-period, and 90-period days, in this case, these are days on this chart, the 10, 30, and 90-day regression line slopes, and then we took the z-score. We computed the average and the standard deviation over the last 5 years, and then defined the channel between 1 and -1 as the boundary of normal. We could then plot these z-scores of those regression lines, and what we'd have is an adaptive measure of market goodness, market volatility. So where are we right now? Well, back here in the early days of this bull, around 135, 140, the 90-period regression line slope, the red line, bottomed out at a -0.3 or 0.4 z-score, and then has made this sustained move up to 1.3, 1.4, and is holding carefully and steadily above the boundary of normal, which we set at plus or minus 1. The 30-period moved all the way up to +2 standard deviations on this last move up to the peak at about 167, and then sold off pretty sharply over the last 7 to 10 days. That rollover in the 30-period regression line was accompanied by a sell-off in the 10-period regression line, or maybe the smaller fraction. And it has just started to rebound here after strong buying on Thursday and Friday, and it's finding support right at the plus or minus 1 standard deviation, just like it has the last 5 times. When this was, in retrospect, a great buying opportunity, so was this one, and so was this one. So the power of investing is worth if you can get the timing right. So what we have is a 90-period regression line that has never even pulled back into the river. what that says is that the upward trend, the longer-term trend, is still very powerful and still very positive, and this should be treated as a buy-on-dip opportunity until proven otherwise, just like it has been. So the 30 has pulled back from +2 back to 0.5, so it's back well within the bounds of normal. And the 10 period sold off to the -1 z-score and has now started to hook back up based on the strength of buying on Thursday and Friday. So that's very favorable conditions for a market that wants to keep moving higher and is willing to go take a run at 168. There's room 168 to test. If it gets through there, then 170 is an easy target. And if we take each one of these legs up as sort of a standard move over those 30-period time frames, then we wouldn't be surprised to see a move from 50-point move from 160 to 175. Okay, how are we doing now? Is the sound back? Okay, sound's back. Let me repeat then. All right, so what we have is a market that is a move to the upside is the normal condition, because what we have is price has been oscillating on the upper bound of the river while the regression line 90 has been rising. The RL 90 remains above the 1.0 z-score, so we still have a strong bull, and we should be interpreting these pullbacks as dip opportunities as indicated by the 30-period regression line slope. During this entire bull run, the southern edge of the river has acted as support, and that's why I advise that when we're looking for re-entry opportunities, you can let that thing pull all the way back to the southern edge of the river, and as long as it's finding support with the universal re-entry, you can take those kinds of plays because of the inherent strength of that 90-period regression line, which has been long and strong here for almost 4 months. Is there going to come a day when it can't make that new high? Yes. So we're expecting failure at 168, and that would start to signal the end. But 168 is the target. If it closes above 168, I'm happily becoming the trend follower once more. So that's how I use these two charts in tandem here, is to take a look at the z-scores, which is a self-adapting measurement of relative slope over the last periods of time. It's self-normalized, self-adapting. And then just the insight here that in long trending markets up, price oscillates around the green line, which is the upper end of the river, or the Bollinger Band +1, and then finds support somewhere at or north of the southern edge of the river. That's basically everything I want to cover there. We're 45 minutes into it. The sound might have been a little dodgy there. That material has been covered also in the executive summary. It's hanging on YouTube as well. I'm going to hang this last little piece that talks about this chart there as a separate recording anyway. So pending your questions, that's everything I want to cover. I think this is a trader's market. I'm looking for a test up to 168. If it closes above 168, it's easy to become a bull once more. If it fails, we're looking for absolute support at 158. If the support at 158 fails, then it's Katie bar the door and look out below. So I just sent around a note to everybody that it's about an 8-minute summary of the Tortoise Research Weekend and live trading workshop. No, it's one N, Dan. KEIER 8, just one N. Yeah, Gerald, we're all done. Yeah, end of workshop or end of webinar. So pending your questions, that's all I have for tonight. The executive summary is going to produce and hang this last little section that describes this last chart. All right, cheers, everybody. That's all I got. Keep your risk measured and your powder dry.